Week 7 of documenting my trading journey. This week, I focused on illiquid markets developing an algorithmic trading strategy for prop firms. Today, we're going to look at last week's goals, the sentiment from this past week, the new strategy I was developing, different type of Monte Carlo simulations, how to get an algorithm applied to a prop firm, takeaways from my readings, and next week's goals. Last week, I set out to create a new strategy with multiple different variables that affect the net profit, explain the 3 different types of Monte Carlo simulations, and figure out how to get an algorithmic trading strategy to a prop firm. I have completed all those goals this past week. This week, I finally began to see the work that lies ahead. I now have all the tools to be able to do what I want to do, and I know how to do what I want to do. Now it's just going to take a lot of time and a lot of iteration to be able to do it. This week and last week, I've really been focusing in on this middle section of the strategy development framework that I created. Learning power language, getting trading ideas from research papers, coding them and then testing them in multi-charts, and then the new step that I added, optimizing them while trying not to backfit. Like I mentioned at the beginning, this week I wanted to try to target more illiquid markets. So this strategy was for Bitcoin, and it was based around volatility and took into account heavily the RSI. Implementing the algorithmic trading strategy on Bitcoin futures. So I took the research paper focusing on volatility of Bitcoin and the RSI, had AI code it into a strategy that could be deployed in multi-charts, as we see, and then backtested it over 1 year and 4 months. Results of the algorithmic trading strategy for Bitcoin futures. As we can see, over this given time period, we had a less than ideal result. The net profit was negative. However, that is not all bad. This strategy has a somewhat high beta, and overall, the market did go down significantly over this period that we sampled to backtest. So as we'll see in a second, this negative net profit is not as bad as it initially seems. Here we have a comparison of a benchmark buy and hold, and then on the right we have the equity curve for the strategy. And so as we can see, the equity curve of the buy and hold on the left is much more volatile. So although over the entire course of the sample period it has a similar drawdown, it's much more volatile. Whereas with the strategy, you're able to rein in that volatility a little bit with different parameters. And yes, it is still negative, but it's much more controlled. It's not quite a smooth equity curve, but it's tighter. Funnily enough, we can see the net profit of both the buy and hold and the strategy is about the same for both. However, this is the strategy before we optimize it. Optimizing an algorithmic trading strategy while trying to avoid backfitting. First, displayed in the table below, is the results of a genetic search that I ran over the same sampling period for the given strategy. The goal here was to figure out which variables actually have an effect on the net profit. Since I'm varying so many different variables, a genetic search makes the most sense because it reduces the number of combinations compared to an exhaustive grid search. From the genetic search, looking at the net profit on the left side and then seeing which variables actually affected that net profit, I was able to determine that RSI length, MA short, and MA long were the 3 variables that actually affected the net profit. From there, I then ran an exhaustive grid search to ensure that I wasn't missing any combinations. However, I only varied those 3 variables that I mentioned that actually affect net profit. Interpreting the results of 3D heat maps displaying the effect of given variables on net profit for an algorithmic trading strategy. If we look at this 3D graph on the left, we can see that RSI length being in this range right here, where it's about 8 to 9, seem to be optimal. If we look at MA short compared to that, it had a much more negligible effect. So we can see the variance on this horizontal axis is much smaller compared to the y-axis that the RSI is on. Given this interpretation, I landed on 8 to 9 for the actual input for the RSI variable in the revised strategy. Then the 3D graph on the right plots MA long and MA short against each other. What we can gather from this graph is that the combination of a high input for MA short and a low input for MA long is going to lead to low net profit in this area. And again, we're trying to find robust areas, not specific points. Then a medium to high input for MA short and a high input for MA long is going to lead to this more robust area of higher net profit. Thus, for the revised strategy, I ended up going with a medium input for MA short and a higher input for MA long, interpreting the results of a revised back-tested algorithmic trading strategy. Here we can see the results of the revised strategy. We ended up having a positive net profit over the time period where a buy and hold would have resulted in a negative net profit. In a bearish market, we were able to make profit. Even adjusted for commissions and slippage, the net profit was still profitable in this bearish market. However, this may be due to overfitting. Something interesting to note is the dramatic effect of positive outliers on the net profit of this strategy. There are negative outliers, however, they're in a much smaller range than the positive outliers, and this is just reinforcement to let the strategy do its thing and not interfere because you do not want to miss a positive outlier. Comparing versions of an algorithmic trading strategy to a given benchmark. Here we have a visual representation of the strategy development process. On the left, we have the equity curve if you were to buy and hold Bitcoin futures over the given period that we sampled. Next is version 1 of the algorithmic trading strategy that we developed, focusing on volatility and RSI. Here we can see the net profit is still negative over this given period of time. However, the volatility is much more contained. Lastly, we have version 2 of the strategy that we developed after optimizing the inputs while trying to avoid backfitting. Here we can see the net profit over this given period of time was positive. Now we're going to walk through the 3 different types of Monte Carlo simulations. My primary purpose of using Monte Carlo simulations will be this third point here, to help reduce risk, drawdowns, and ensure robustness in a given strategy. Type 1, a trade shuffle Monte Carlo. What this does is reorder the same trades, the same wins, losses, and expectancy, just in a different sequence. The starting and ending capital are the same. What it's measuring is sequencing risk. These matter because it shows how fragile a strategy can be. These matter because it shows how fragile a strategy can be to trade order variance. It reveals the worst case scenarios and is good for highlighting strategies with streaky wins and losses. Type 2, bootstrapped Monte Carlo. This is similar to a trade shuffle Monte Carlo in that it uses your same trades. However, in a bootstrapped Monte Carlo, it may use the same trades multiple times. It samples trades with replacement. The starting capital is still the same as always, but in this case, the ending capital can vary. Bootstrapping matters because it can show what the strategy might perform like in future conditions or alternate conditions. The main reason I intend to use bootstrapped Monte Carlos is to help avoid overfitting when optimizing a trading strategy. Lastly, the third type is projection Monte Carlo. This simulates future trades. This simulates future price paths or future trade outcomes and does not reuse historical trades. The starting capital is the same, but the ending capital can vary massively. As we can see, all of these equity curves start at the same point, but each of these lines, each of these endpoints, is a hypothetical future ending capital. There are 2 main types of projection Monte Carlo. One is price path simulation, where you generate synthetic candles and then run your strategy on them. The other is outcome distribution simulation, where you use win rate and payoff distribution to generate thousands of hypothetical trades. To compare the 3, trade shuffling Monte Carlos are ideal for identifying sequency risk and fragility. Bootstrapped Monte Carlos are best for eliminating overfitting when optimizing a strategy. Forward projection is best for hypothetical futures and potential outcomes of a given strategy. Last week, I set out to figure out how I could connect a multi-charts algorithmic trading strategy to top-step prop firms. I found out very quickly that that is just not possible, and TopStep does not allow automated trading strategies. So, for prop firms that do, how would I do it? How to use an algorithmic trading strategy for prop firm challenges and payouts. There are three main ways people do it: direct API trading, bridge software, and then manually. The first involves using your bot through the prop firm's API to execute trades on the prop firm account. This is ideal in the most automated version. The most common is bridge software, where your algorithm is ran on a third-party software like NinjaTrader or Sierra, and then those trades are executed in the prop firm account. Lastly, no automation allowed. Now, why did I include this? Because you still can run your automated strategy just in a separate platform like TradeStation or Multicharts and have signals for when you're supposed to buy and exit and sell, and then manually execute those signals. It is still using your algorithm, just not automatically. Is the market on the verge of a bubble? Takeaways from my reading this week: just the bubble. Everyone is talking about this potential bubble. Just random people I've been talking to, hedge fund people, quantitative finance people, global macro people. Anyone and everyone is talking about the fact that we're on the verge of a bubble. So the big question is, what does that mean? Does that mean you still just dollar cost average invest? Does that mean you pull out of volatile positions that are going to be dramatically affected by the bubble, AI positions? Do you move a lot of capital over to bonds and risk-free returns? Or do you just continue as normal? A strategy that's algorithmically proven and seems to be the most ideal is just wait for the bubble to pop and then invest a large sum then, because it will recover. Now, that sounds great in practice, but what if the bubble doesn't pop? What if it's not a bubble? Are you just never going to invest then? This is why I think a hybrid strategy of potentially dollar cost averaging a small amount while holding large cash reserves in a time like today where there are large threats of a bubble, to then be able to reinvest on the dip. However, none of that is advice, and I don't know what I'm talking about. Last week, I proposed a quant project to another peer who's interested in quant, and we have set out on a project to develop strategies through Quant Connect. My goal for this upcoming week, the main thing, is to develop 2 different strategies around 2 different principles in Quant Connect and explore the platform. Next, we just went over Monte Carlo simulations. I want to focus on how to apply those in my pursuit of learning how to trade quantitatively, especially bootstrap Monte Carlos and forward projecting Monte Carlos. As of now, I've only used trade shuffle Monte Carlos. And then this kind of could be blended together, but the first is I want to learn how to do it. And then second, I want to actually do it. As always, gotta throw it out there. This is just a journal, not educational. I'm in no way an expert, and it is not advice.